great divide has typically been between physical replication and swap-based ETFs. What would you say is the current state of this debate and which side is winning today?
I don't think it's entirely a matter of winning, in that we've had this debate in the industry, and ETFs tend to be the most transparent investment vehicles that investors have access to. The regulators have looked at both of these formats, and they've come up with, or they've come to the conclusion that there is not much difference between them. They are both, they comply to all the regulations, and therefore, are suitable for investors. And there are risks inherent in any type of investment, from an operational as well as from a investment level. So the regulators have come up agnostic between the two. I think the investment community has different outlooks. So there are certain investors that have taken, has said, no, I prefer to go physical. Others will go synthetic. There are advantages and disadvantages to both. But ultimately, having that education, understanding how you get that exposure, and as long as the product does what it's meant to do, then I think that is, that's what the investor is looking for. What you've seen, though, through this debate and through what happened in 2008 and further on, is that the disclosure levels in both, the physical and the synthetic, have come to, and also regulation has moved up, have come to a level where the information is at the fingertips of the clients. So what you've seen now from the synthetic level, when a fund potentially is holding what's called a collateral basket, but a physical basket, and getting the exposure through a swap, you actually have that on a daily basis. People can look at it. You can actually have very liquid collateral in many cases. In some cases, you may actually have more liquid collateral than what the exposure you're giving. So in a stress scenario, that could actually be an advantage. On the other hand, again, from the physical replicating funds, if they're securities lending, you actually now have what they're lending out, what amount of the fund they're lending out, etc. So that gives you some confidence as well in terms of what other counterparty risk you're taking. So this disclosure is I think way above any any kind of disclosure that you're likely to get from most other funds that you invest in, and I think it's good for the industry. I think it's good that it's kind of pushed that information out, and it's made better products of all of them.
I think, Mark, you may beg to differ slightly on some of those points.
Perhaps maybe I could offer some different experiences, perhaps. Maybe a better way of putting it. Because you mentioned, obviously, Philip, that the regulator has agreed that no matter what format the ETFs are in, that they're all okay. Actually, what we tend to find, differing countries have different views. There doesn't seem to be a ubiquitous answer on that. So, for example, in the Netherlands, where we are based, we see that the regulator kind of gives a sort of agnostic view to the style, but in fact, when you look at their recommendations, they say if a client is being advised, then it doesn't matter if it's physical or swap-based. If a client is self-guiding, then they should only invest into physical, because they're not able to understand the complexities behind a swap-driven product. And this leads me a little bit back to the original question of what you said, Yuri. Is the product development, is it being producer-led or client-driven? Well, again, it depends on who the client is. And if we're looking at private banking clients, the majority of which are high net affluent, excuse me, I think you scare a lot of people off when you start to talk about swaps, collateralization, over-collateralization, and it scares not only the clients off, but also the wealth advisors. They had so many scares in the last few years that they would just be driven away from that idea. And that's interestingly enough, if I look at our European exposure, we see that in Germany they are, I find, relatively agnostic. In France they prefer swap-based because of tax reasons, and in the Netherlands they prefer physical. But the problem is, if I look at the Dutch market, there are certain tax advantages to be had from having Dutch-based vehicles for Dutch investors, and none of the industry has really paid attention to that. So as a result, what we've only seen in the last year or two is that some providers now are creating specifically targeted Dutch transparent tax vehicles for passive or ETF investments, which have been completely forgotten about because I think the market has been very much producer-led and pushed onto clients. And only now people starting to wake up. So I do see different angles to this than just some of the comments that Philip was making.
But I mean, these comments about the regulator being agnostic, I'm kind of not so sure about that, because we had the Bank of England decided nearly 3 years ago in its financial stability report, together with the FSA, to question the use of this product, suggesting synthetic ETFs exhibit more of the characteristic that might contribute to the build-up of systemic risks. And some wealth managers have indeed decided to ban the use of synthetics in their portfolios. Eric, at SGPB Hambros, are you one of these managers who've decided against the synthetic ETFs in your portfolios because of these risks that some of the regulators have identified?
We're actually using both in the way we manage portfolios. As it was mentioned, there are some advantages on both type of ETF. If you go for a synthetic ETF, you may have actually a less costly structures, which may help the performances. Of course, you may have some counterparty risk, and that you may want to avoid. I think what is important is to know what you are investing in, and we mentioned the transparency. The level of transparency has been increased so much now that you can actually on a day-to-day basis see it's actually the collateral of any swap that is done through ETF. So the situation has changed a lot, I think, since the statement you mentioned. So I mean, transparency is key. Going back to the transformation, maybe in terms of portfolio management that you mentioned before, I don't think the popularity of ETF is really changing the way we manage our portfolios for private clients. It is a new vehicle, a new wrapper that we use. It is very convenient. Instead of doing a basket, for example, we used to do some basket tradings for some accounts. Now we would buy an ETF. It doesn't cost a lot. We know what we are buying. We want something usually with a very, very low tracking error. So that's what we use ETF for. And I would say that next to that, we continue to use funds, as we still think that there are some portfolio managers able to add some alpha. And for those portfolio managers, we want them to have a high tracking error. So I think the popularity of ETF is killing the portfolio manager or fund manager who are in the middle. Those who are doing index tilting, meaning that part of the portfolio was in a way index, very low tracking error, and then some of the stock selection were very high. I think this model is going to disappear, and we're going to see more and more actually high tracking error portfolio manager coming in.
I would say from the due diligence and research we've done that swap-based ETFs, and it's a bit of a generalization here, do give better statistical results in terms of tracking error and tracking deviation, although that reflects part of the embedded cost structure, which still in some firms is very rich. But when you look at categories where the pricing mechanism of the underlying is more OTC match bargain rather than a continuous two-way publicly priced market, or across multiple time zones, or when you have both factors, swap, I think, gives you better results. The trends you spoke about, and you spoke about in terms of improved visibility, which is effectively a virtuous circle in terms of better questions and RFPs from the consumers in Europe and so on. I think the differentiation in terms of swap or their weaknesses have narrowed considerably in terms of both the transparency of the collateral basket, the structure of the collateral arrangements, and what's in the collateral basket, which now bears a tighter relationship, though not perfect, to the underlying. So there is a demand. I think there's a really good use for swap-based ETFs. The problem, I think you summed it up, is a PR issue, because in the wealth management world, clients still are very biased towards and inclined towards physically backed, irrespective of whether it's less cost effective in terms of a total round trip exposure.
But how important are the costs to you?
Very important. And it's not just the headline total expense ratio or ongoing charge. It's a concept of the total cost of ownership, round trip, how much it would cost to get in, how effective, how easy it is in terms of pricing execution, holding period cost and exit cost. And that's very difficult to measure. And we can get on to off-exchange trading and pricing and trading transparency and visibility. And that's a whole different story.
And some voices in this synthetic versus physical replication debate, they've been saying, Eleanor, that we should be more worried about the securities lending practices, which have been an issue for yourselves and other banks, and those can tend to affect physically backed ETFs more than the synthetic ones. What would your feeling be on those questions?
Well, certainly in Europe, our spider ETFs, I think one point here that is really important is not all ETFs lend. What I would say is all of our Irish domiciled ETFs, for example, our spider ETFs do not lend. The prospectus allows for that, but the management of the company have decided to not lend there. And I think it's important that in some cases, securities lending is not a new phenomenon. It tracks back to, I think, the mid-70s. It came to Europe in the 80s. A lot of sovereign wealth, a lot of pension funds have been, and hedge funds have been active participants in the securities lending market. ETFs, there are some that do lend inside, but as I said, I think it very much depends on the actual individual ETF. And I think it goes to a due diligence question, which is make sure you understand which funds do lend, why they're lending, and whether you have the transparency and the knowledge around that. That's critical. It goes to the point around education. I think ETFs here have been an innovator, not in the product development sense, but in educating around asset management generally. So the whole discussion between PR or otherwise led, it doesn't matter. The point is, all of a sudden, you have an investor base that is far more familiar with these questions and answers around what to ask their fund manager on securities lending or swap provider, where if there is securities lending, where is that happening? And I want to understand why. And I think the regulator caught on to that and has asked really deep and meaningful questions on behalf of, let's face it, to protect the retail investor here. And I think they don't have necessarily access the way many intermediaries do to that information. So I think from my perspective, the innovation here vis-a-vis the ETF industry didn't come about vis-a-vis product innovation, which has tended to happen, but actually more on sort of techniques within asset management that is big, has a long track record, and there is risk associated with that, and how is that risk managed? And those are really important questions. But each ETF, even within one ETF provider, there are different prospectuses and things that need to be met with a fine-tooth comb, and everyone around this table that is an investor knows exactly what I'm talking about.
Yuri, can I just say something about counterparty risk? I really think we're fighting last year's battle. It's a legacy of Lehman. It's ridiculous because actually, in this great magazine where you've got some asset allocations, there's all kinds of leverage swaps. There's in UCITS. Yes. So we're talking about UCITS. There's Marshall Wace Tops. There's one of Alan's favourite, Standard Life GARS is in here. And, it's full of swaps. So our clients are exposed to swaps all over the place in UCITS. So it amazes me why people are so hung up about it within ETFs. It amazes me that clients will happily own Standard Life GARS, full of lots of good product. We own a little bit ourselves, full of lots of leverage swaps, and other UCITS. And then when you see it in an ETF, oh my God, there's a swap in an ETF.
Right, but it's the ETF that's educated and has allowed investors like you then to maybe potentially ask those same questions to your other managers, or you get comfortable around what the risk levels are and how it's being managed, whether it's in an ETF form or otherwise. But I think pre-ETFs and the discussion around swap versus physical didn't even happen.
But I would add to that, and I think the point you've made is very clear and very pertinent in that one is the ETFs have been asked those questions, and we're fighting last year's battle in that sense. But also the questions aren't being asked, and they don't need to be asked of the GARS fund or any other multi-asset class fund. It's just that due to the transparency that ETFs as a product group have, they've allowed, which is great, so they've allowed investors the full disclosure, which I think is unlike most of the financial products in this industry. And through that disclosure, I think people have been educated. And to the level of their education, it also depends in terms of their adoption. But at the end of it, I think it's fair to say that one should look at whatever disclosure is there and choose the products that are suitable for their purposes, whether they be indexing or multi-asset class, etc., based on their criteria and the transparency and the information they have to hand.
But you know what, but I think just bring it back to last year's battle. I'm not sure the topic of swap versus physical is last year's battle. I think the battle is, do investors know what they're buying and do you know what they are allocated to?
I think the Standard Life GARS fund is astonishing because the number of advisors who can't possibly have a clue what's inside it. I mean, I always say to you, you're a man who knows this, but I ask the question, what is a Euro steepener? You know, you're the first person I've ever asked who actually knows the answer to that. That's been one of the largest strategies. So if the investors don't understand one of the largest strategies, they don't understand within the GARS fund, not just the amount, but who that counterparty risk is. It is like an old-fashioned global macro hedge fund. Exactly. But because it's like a UCITS fund, nobody seems to be in the slightest bit kind of nervous about it. If it was an ETF, it would be kind of, you'd have all these front page headlines on how dangerous it was. But because it's used by every single known pension fund, who seem to think that the global kind of centre for intellectual excellence is all located at Standard Life. It's grown into this phenomenal fund, which kind of, at some point, that's going to defy gravity.